as well. So not very much to really show for one way or the other this morning in terms of market opening. So 25,230, absolutely 30-point kind of flattish start. The Nifty heat map gives you a quick sense of where we are. So Maruti, Eicher, M&M, etc. on one end, Bajaj is all auto, Hero. So the top 4 gainers of the Nifty are all auto names. On the other side, you've got Sun, Eternal, Trent, etc., which is coming through. But majority, about 30, 32 names are in the green right at the word go. Rima.
Well, it's autos all the way where you can feel the festive cheer. And as you pointed out, the Nifty Auto Index is leading from the front, top sectoral gainer, and that's up close to about 1% IT after yesterday's gash isn't recovering, but at least it's not falling. So it's a flat opening on Nifty IT Index, absolutely unchanged. Talking about the winners, well, the top 4 are auto names, Maruti, Eicher, M&M and Bajaj Auto. Maruti right on top, and it's a fresh high on that. It's crossed the 16,000 mark today, 16,180 on Maruti. For Eicher Motors too, it's a fresh 52-week high, 1.5% up on Eicher Motors. After that, you are seeing a Bajaj Finserv seeing some interest in buying. That's up close to about 0.5%. In IT, Infosys has rebounded. Infosys was down close to about 2.5% yesterday. It's up nearly 0.5%. On the way down, Adani Group stocks are correcting after 2 days of a heady run. Adani Enterprises, Adani Ports under pressure, both down nearly 1%. Softness seen in Sun Pharma. Eternal is a bit subdued. Tata Consumer, Trend. In fact, if you pull up the sectoral movers, it's the FMCG index, which is a bit downbeat, and Realty too, and PSU banks. I think these are some of, sectorally at least, at an index level, where you can see some red.
Well, that's right. A few stocks, Rima, from the broader markets that are bucking the trend. You have JBM Auto. They have partnered with a Dubai-based firm to launch e-buses in the UAE market. Could explain one of the reasons why the stock was bursting away. It's up 4.5% as we speak. If I'm not mistaken, though, I think this came in market hours, actually, towards the end of market hours. Stock, though, up close to around 4.5%. So good move is what we're seeing. KEC International, they told us here on CNBC-TV18 just a week ago that they're likely to close out a 3,000 crore order. That's come through. The street loves it. The stock bursting up close to around 7% or thereabouts. So even though the street was anticipating that, clearly giving a big thumbs up on that counter. What else? What's doing well? Om Infra, we don't talk about this stock too often, but that one is moving higher on very large volumes, more than 10% up on this particular name. So I'm not sure what's gone on there. You have all cargo terminals, volumes fairly decent, stock up close to around 7%. So good up move is what we're seeing out there. Zuari Industries, no, not very high volumes, only around 50,000 shares. So that's another stock that's moved higher, just in the first few minutes itself, up and about 7.5% higher. What's not doing well? The pain continues for Dreamfolks. Now it's down to around, 105 rupees thereabouts, 1/5 of what it was at its peak. And you have Hariom Pipes. That's coming for profit taking. Had a big run last few days. Stock down close to around 3% or thereabouts. So good start is what we're seeing. Some green. Mid-cap index still trading in the red. Let's see how this goes. But after a couple of days of pause, a little of consolidation, let's see whether or not the bulls can fight back.
Urban Company is also taking a bit of a pause, right? Had a one-way kind of a move. It came off the day's high yesterday. Fifth day, right? Fifth or sixth day in the markets? Yeah. So basically, listed at about 162. Yesterday's high was about 201. And finally closed at 186 at 193 right now. Urban Company, large amount of volumes on it right now. NetWeb, we've been highlighting this, right? It's gone up like a rocket. Absolute rocket. It's down about 4%. This year it's up. This year so far is up 25%. Of course, 2024 was a massive re-rating year. Anand Rathi is down about 1.6. I mean, these are just small pullbacks after very large, impressive runs that most of these stocks have had over the last couple of days. Suddenly, I sense that the momentum, at least in the broader market, is swinging to the positive side. So KEC, I think we highlighted, right? 7% yes. On KEC now. So 928 is the second largest volume-led gainer right now on the NSE. Of course, I mean, all the auto stocks we've been talking about. E2E Networks is up another 5%. That's another one which has been like a rocket move lately. Taj GVK is up about 3.5% or so. MK is coming up with about a 1.5% pop. Sonata Software is up 2%. Sirma is up 2.5%. Thermax is up 2%. can go on with more, but volumes start to thin out. But this is the majority of the volume-led gains that we are spotting for you. Rajiv Batra is head of Asia and co-head of Global Emerging Markets Equity Strategy at JPMorgan. He's joining us now from the sidelines of the 10th annual India conference that JPM is holding right here in Mumbai. Rajiv, it's always a pleasure to have you on CNBC-TV18, and thanks for joining us. Let me ask you to tell us the big questions you are being asked, Rajiv, by clients, investors about India, because we've had a period of relative underperformance. But as James Sullivan and others have been pointing out, it was, of course, the last 1 year has been followed by a couple of years of sharp outperformance. So is it just that, or it's a mix of things? What's top of mind, Rajiv?
Good morning, Prashant, Rima and Nigel. And first of all, happy Navratri to you and your viewers. Overall, a good start of the festive season with all hopes and prayers from my side too. The questions which commonly being asked, number one, question is when we expect a thaw happening in US and India relationship. That's the number one question to me and my management right across over here. The second one is when we can expect the double-digit growth handle, because now 4 to 5 quarters have gone. India is still trading at close to 5 to 6 peg ratio, and market wants them to come at a 2 peg ratio per se. So the double-digit growth is the second one. And last but not the least, when do we expect foreign investors to come back to India after last 4 years of exodus? Because it's not just a 1 year story. If you look at cumulative flows for the last 4 years, FIs are missing in India. So that's what we are trying to address and trying to show them on ground that what is happening in India and why you should revisit the thesis. And especially where India is seeing the worst ever underperformance since 1990 of close to 25 to 30 odd % in a scenario where EM assets or Asian assets are making a comeback under the big diversification theme because of the dollar weakness, because people want to move away from US denominated asset class. In that scenario, India is still not making a comeback. So this is the kind of a questions we are all trying to address through ourselves and making them meet even experts also on here.
So Rajiv, how are you addressing the question on when FIs will make a comeback into the Indian markets? What is your own sense, speaking to so many experts and investors since yesterday?
So Rima, it's all interlinked. So number one most important perspective if I want to see is how the relationship continue between India and US. Remember, India and US have been doing businesses, investment all across for 25 good years between each other. And US have emerged as one of the biggest partner for India. And we have seen the pleasantries which was being exchanged between President Trump and Prime Minister Modi during his 75th birthday over there. So investors want to see now this to be taken one step further, maybe by reducing tariff by 25%, the additional penalty that was imposed on India 1.5 to 2 months back. So thawing of relationship is the catalyst number one, which can lead the risk premia in India to get lower, and India's P re-rating can happen in line. Again, this is a contrarian view I'm giving you, a P re-rating for India, what other emerging markets have enjoyed year to date or for the last 1 year, and India has not enjoyed at all. That's number one. Number two, the earnings momentum or revival of earnings. Remember, as I've said earlier, 5 quarters have gone. India's trailing 12-month earning growth is in handle of around 4.5, 5, and trading at a PE of around 22. Investor want double-digit handle to come. That justifies India PEG ratio close to near what S&P 500 is trading, 2.1, 2.2x kind of a stuff. And that's where India makes a comeback. And lastly, continuing the good work, which we have seen in form of 3 arrows. Arrow number 1, monetary policy easing. Arrow number 2, in form of tax rate cuts during the budget. And arrow number 3, the GST cut. Now the market want to hear the 4th arrow, that is the next generation reform in form of deregulation and easing my FPI and FDI entry into India markets. So these are the 3 set of measures what markets want to hear.
Okay, all right, Rajiv, good to see you again and hope you're having a good conference. Let's focus on the third point that you mentioned. GST 2.0, that's clearly got a few sectors very, very excited. Case in point being autos. And you all as well have done a bit of a pivot. Do you think that sector is set for better times? It's already had a bit of a run. I think earlier you all were neutral on that sector. But how do you expect this sector to pan out from here on?
We think it's a start. It will lead to an improvement. It's very easy for people to anticipate when the GST cut is happening. It will be just benefiting staple. In reality, when you start saving more, you will go behind your aspiration and more of your discretionary consumption, which you have been postponing because of lesser amount of a saving you have in the past. Taking that into account, step one, I never anticipate people will start going straight into the real estate sector, buying houses. But the easier one is more four-wheelers, more two-wheelers, and even some jewelry stuff also for their near-dear ones overall. So discretionary items are the one who will be the beneficiary. And I don't think it is just a 1 quarter, 2 quarter story, because GST cut is not one-off. It is here to stay. And like we have started with the GST cut, maybe in 12 to 18 months, on the same show, we will start talking about even the 8th pay commission, which also will be a bigger driver for consumption, or you can say further accelerator for consumption after the kind of a 3 arrows which we have seen so far.
So better times ahead then for the auto pack.
100%. It's consumption over capex, and that's what we are going to see for the next coming 4 to 5 years in India.
Okay, all right. The uncertainty continues on the tech pack though. A bullish argument would be that they have not done much, they have underperformed. Maybe the bad news is in the price. But when you get sound bites coming in from the United States like we saw over the weekend, maybe it's not a very material impact. Most sell-side notes had written that. However, the index itself was down 3% yesterday, telling you the kind of nervousness on this sector. Do you think there's still more pain, no big growth, headwinds coming in from the United States, and deal closures taking longer than anticipated as well? So you'd rather stay away?
No, we are more in a transition kind of a phase at this juncture, because market is trying to figure it out where we are heading in this kind of a geopolitical uncertainty, what kind of a world we are in, whether it will be a unipolar, whether it will be a bipolar, or whether it will be a multipolar kind of a world over there. And definitely then my exporters are at a stake in this kind of a world which we are going enter into. Taking that into account, it's unfair then to give a lower risk premium to such sort of a places. And the better way to trade this space is through earning growth. Now, growth is a key problem in IT sector from the last 12-month perspective or last 24 and 36-month perspective. They kept on delivering bottom line for you by cutting down people, by firing staff over there, and still delivering growth for you. But right now we are at a cusp where your IT sector growth has come down less than 5% on a 12-month trailing basis. We saw the similar things happening in the FMCG sector also for close to 10 years. And unless the revival apply, people never gave FMCG sector 60, 70p. They were bringing it down to from 60 to 50 to 40 to 35. I believe in IT we are heading in same phase unless IT gets back 10% plus kind of an earning growth from a future lens perspective.
And that, for now at least, looks a bit unlikely for this year and next. Rajiv, just the bigger picture about emerging markets. Now, you believe it's the coming of Goldilocks market when it comes to Asia ex-Japan. Can you explain your thesis? And it's had such a good run. I mean, this is the best performance we've seen since the dip in April. Is there a risk that the positive catalysts are now, we're running out of positive catalysts?
Not yet. I think this is just a start. Just to share some number with you, a 1% dollar depreciation leads to 4.5% increase in EM equity performance based on the historic sensitivity basis. This year, dollar has gone down 12%. If you take that sensitivity into account, you need to be easily up 50 to 54%. EM is up close to around 28%. Asia is up around 26% only, which means there is still performance based on the historic standard pending. Now, going into the next year, JPMorgan is forecasting end of this year DXY at 95, and by June next year, 92, which means further 5% depreciation. And again, you multiply same sensitivity, another 25% return. If dollar is on the downward slide, diversification is going to remain a criteria. And not only equities, across asset classes in Asia, in emerging market, we are going to see benefit. Look at this year, Asia ex-Japan index is up 26%. Fixed income in Asia has given 7% return. Cash has delivered 3% return. And most of the currencies have driven 5% return. next year, when we are going to see a synchronized global easing, where my US is increasing its fiscal deficit, Europe is also doing the same, and China, to revive their growth, provide you 40 to 50 basis points of fiscal thrust, along with 80% of global central bank easing. What does it mean? It means we are entering into synchronized easing cycle, which has happened in past during either GFC or during COVID. And after that, we all know what happens to risky asset classes and market. So we are entering that environment over the next 12-month period, which means we are just at the start over here. And if you take my positioning into account, global investors are 800 basis points underweight on emerging market. This year, they have not participated in EM equities fully, and they have missed the rally. Korea, China, Taiwan, all rally has come on the back of domestic money per se, which means my FIIs will be the chaser into this rally as you go into the next year.
So how much more upside for emerging markets? I mean, in percentage terms?
So we are working for our 2026 outlook targets for EM overall. We have just surpassed our bull case on emerging market of 1350. The 12-month forward Asia ex-Japan index target is 1,000 points from here on. And we are saying it will trade at 16.6 PE, which is still below 2007 territory and 2021 territory. But the kind of a liquidity train which is going to hit us, I'll not be surprised the regional indexes going to trade at even at 20 PE also.
Rajiv, on that point about synchronized rate cuts, right? Global synchronized kind of easing. The call is that economies stay strong, but you get rate cuts. So best of both worlds in that sense. That's the call. I mean, you don't see significant weakening because then, in response to that, if you get a cut, that's not exactly great. But you're saying that economies will remain strong to so-so, but you get rate cuts.
Prashant, that's what's been happening since April. In April, US have made 4 pivots for us. Pivot number 1, they talked about fiscal austerity, and they have given us OBBA. They set the low. Second, they set the lower bar for Fed also to cut, and now we have seen Fed has started cutting. We are calling for 75 basis points more rate cut from here till March by the Fed. Third, we all worried about the AI diffusion law, not supplying the high-end tech to the US over there, but they have eased the chip exports and everything to the rest of the world. And last but not the least, we worried too much about the tariff at the start of the year. But what happened finally? Deals are happening, tariffs are much more measured over there, and exports are still growing. So taking that into account, where my economy is still growing higher, and consensus economists are literally eating back their word and revising growth higher. Remember, consensus was forecasting recession in the second half of this year, and now all the forecasts in the US are for around 2.5 GDP growth in the third quarter, 2% GDP growth in fourth quarter. And mind it, for the next year also, growth number is 1.9, which means they want to run economy hotter going into the next year.
Yeah, no, absolutely. Great conversation, Rajiv. Thank you very much for joining us, and hope you come on more often. Good sort of 360-degree perspective.
Thank you.
With you, as always. Well, I think I want to play out one important soundbite here now. So, India's chief economic advisor, Anand Rathi has said that he expects GDP growth to be near 7% this year after the GST cut. Speaking with CNBC-TV18's Shireen Bhan on the sidelines of Network 18 Reforms Reloaded Summit, he said he expects revenue growth to remain on track and is confident of achieving 4.4% fiscal deficit targets. Listen in.
Fiscal second quarter growth numbers are looking quite promising based on the high frequency indicators we track. But of course, that is still only about 1.5 to 2 months of data. So we have to wait and see how did September fare, etc. But we're sort of quietly hopeful that the second quarter has maintained the momentum that we saw in the first quarter.
And so closer to the 7% mark is what you're hoping for, on the back of what the information you have.
I'm hoping for, rather than saying I'm predicting it. I'm not predicting it.
Fair point.
I'm simply saying, based on the trends I have seen, it's the number that I hope for. Yeah. We are confident that the final number will be 4.4% of GDP, which is the gross fiscal deficit. We have had good non-tax revenue growth, and overall revenue growth is on track in comparison to last year's numbers. And we feel that the festival season will last all the way until the end of the year because of successive, the Diwali festival spilling over towards Christmas and New Year, etc. So we are confident that the fiscal math will hold up very well for the current financial year.
All right, let's focus on the steel sector. And we have Nomura that's come out with their view on the steel space itself. They're turning bullish on India's steel sector. They're citing a mix of both global as well as domestic factors into play. That includes the production cuts that we've seen in China, potential stimulus, and the improving local prices as well. They're forecasting 25% EBITDA CAGR over the next few years across the steel space. On JSPL as well as on JSW Steel, they have a buy rating. Target prices come up for you on the screen, 1,300 rupees. And 1,150 rupees. For JSW Steel, well, 3 big points stand out. One is the capacity expansion of 7 million tons by FY28, aligning with the cyclical recovery. They're also targeting 50% self-reliance in iron ore through backwardation, which is good. Backward integration always, holds them in good stead. And they're better placed than peers with domestic iron ore prices expected to stay below import parity. So that's about JSW Steel. Moving to JSPL then. They highlighted the following reasons. A planned 6.3 million ton capacity addition by FY27, which will boost the product share, the flat product share to around 65%. They're also looking at enhanced raw material integration, and they're expecting cost savings from the new pellet and captive power plant. So sum things up. Basically, Nomura is seeing better times in the steel sector. Capacity growth, cost control, and supportive macros as well will help them in terms of earnings from here on. So that's what Nomura has to say on the ferrous space. Moving to the cement space, though. We have with us Mr. Neeraj Khoury, the Managing Director at Shree Cement, who joins us on the show. Hi, Mr. Khoury. Good to see you in. Well, before we come to you, we're just going to alert our viewers about the 3 big points we're going to be focusing on in this interaction. The impact of the GST rationalization, long pending demand from the industry that's come about, the update with regard to progress on capacity addition, and finally, Shree Cement is sitting on a lot of cash. How will they use it? That's going to be the top 3 talking points. Well, Mr. Khoury, pleasure having you on the show as always, sir. Let's get straight to the first point. Well, considering the recent GST rate cut, how does the industry dynamics change? 2 points I want to understand. One is, what is the effective price cut you have already taken? And second, do you maintain that volume growth stance of around 4 to around 5% year on year for FY26?
So, Nigel, good morning, and thank you for having me on the show. First of all, this is a transformational step, something which we were long expecting. And now that it has happened, we are absolutely clear and confident that it is directionally good for our industry, both for demand growth, but also for ease of doing business. For Shree Cement and for the industry, one of the things that we have done, Nigel, is very clear, is to make sure that we pass on the full benefits of the GST to our customers and the consumers. We believe and we are convinced that it is a right step in terms of boosting the overall consumption growth. Demand growth numbers we had taken 5% till now. We believe with this, there would be some acceleration of demand, maybe 1 to 2%. And that is something that has yet to play out. But our first level estimates would be that demand growth will go up from 5 to about 6.5%. And that is the good news for all of us.
Okay, so around 6% volume growth is what we could expect from Shree Cement for this year?
Yeah.
Got it. All right. Also, the other question that I had was, since cement is going to get relatively cheaper, people may want to upgrade the kind of cement they're looking at. I think premium sales for you as a percentage of trade sales is roughly around 17%. You could correct me on that number. So do you think that's likely to be the case, where people start using better quality cement, more premium cement, and that would help you in terms of premium as a percentage of your sales mix moving up?
So Nigel, in any market, there will always be a different segment of buyers. Value buyers will remain value buyers, and people who would like to upgrade will like to use this opportunity of reduction of cement prices to upgrade their the quality of product that they are buying across segments. We believe that yes, premium cement sales for us would go up. We are at 17% till now, and I think we would see this to go up to about 18, 19, 20% in the near term. This is our first level estimates. I'm sure we should be able to meet this kind of a number, the targets of 18 to 20% now with the reforms in GST.
Got it. So we've got a couple of numbers out. Volume growth of around 6%. Premium as a percentage of sales mix moving to around 18 to 20%. But do you maintain that strategy, value over volume strategy? And are you on course to deliver that EBITDA per ton number of around 1,350 to 1,400 rupees for FY26 on the whole?
So I would not like to focus on EBITDA, what we'll be able to deliver. There are so many factors at play, Nigel. Having said that, we do believe that our strategy of value over volumes has played out well for us, and that is something that we would be very keen to continue in the future as well. This is something that is helping us to improve our brand presence. It's helping us to improve our results. And that's a strategy that we would like to follow in the coming months as well.
But you are able to hold on to what you have been doing. You know, last quarter was more than 1,350 rupees. So that should be par for the course, right?
Yeah.
Run us through your capacity addition plan, sir. You know, you had that target of around 80 million tons. By the end of this year, what will the capacity be? Next year and post that as well. And have you all visited some units? I believe a couple of units are on the block. And I know some of your peers who have visited South India as well. Were you all part of the visiting committee?
This question keeps coming back to us, and we are very convinced that our focus has been organic strategy, and that will continue to remain our focus. Having said that, if some good opportunity comes, we would be very, very willing to look at it. But when we said our growth plans, it is largely organic. This year, Nigel, we are at about 70 odd million tons is what we should end up by next quarter, and then we have some more plans to grow our capacities, which we will reveal as time comes in. But so far, we are more than happy to pursue our organic strategy. I think that there is a focus that is there for Shree, and there is a focus that we would like to maintain in the coming years as well.
$1 billion of cash, sir, and the focus is going to be organic growth. Have you decided what you want to do with that cash balance? It's diluting some ratios as well. So the street has been requesting, and we as well on the channel have discussed with you all that maybe there's a plan to utilize some part of that cash. A probable one-time dividend payout could be likely. I don't know whether buyback makes sense as well, going by the change in taxation rules. But should we hear something about it, say at the end of this quarter when you report your numbers?
Nigel, I am very clear this is a board decision. I will not take to comment on it. But we have solid plans on how to use this cash to grow our capacities in the coming years. I'm sure the board will review both of that together. And to me, there's the cash we should be using, and we would like to use to expand our capacities as we go forward.
Just one more question, sir. You know, as part of GST getting rationalized is good news, right? But earlier there was that SGST component as well. And there was some kind of incentives that you should get from the state. One is capex-led and one is by the GST angle. Do you see some kind of risk that since the state will get less money, then in fact it could hit some of your incentives? Or do you think that y'all are reasonably protected on that front and it will not be that big an impact?
It will not be that big an impact, Nigel. There are places where we have fiscal incentives, and most women, the way forward would be that we would like to sell little more in those plants. So I don't see any material impact on the SGST component of the fiscal incentives on our results in the coming years. Final question then, in UAE, you all had announced an expansion plan out there. Could you tell us how is that progressing? What's the expansion plan? Because some on the street thought that unit was struggling, but then you'll clearly see an opportunity that you're going ahead and increasing capacity there. So, as you know, Nigel, UAE has been doing very well in the recent past. The demand in the country is also, and not only in the country, but in the region, is positive. And therefore, we decided to pursue an expansion in our UAE plant. The plan is already under execution. The construction has already started. And we expect that by next year end, we should be able to commission that new capacity of 3 million tons in the UAE as well.
Mr. Khoury, always a pleasure, sir, having you on the show. You're sounding reasonably optimistic about the prospects ahead. September would be a little bit dullish owing to the monsoon as well as GST 2.0 coming into play. But for the year, 6% volume growth, EBITDA could be maintained in that vicinity of what we have seen in the past, and premium sales could get a bit of a leg up. So thanks a lot for joining in. By the way, before we slip into a short break, take a look at the Nifty. That's moved to the low point of the day. We're moving closer to the lows that we saw yesterday. You don't want this 25,100 mark to get broken on the downside. Remember, today is the weekly expiry as well. So that mark should actually not get violated. Otherwise, you could see further selling pressure. So at a crucial juncture, for the time being, though, we'll slip into a short break. When you come back, we'll have Mr. Pradeep Gupta, the Chairman and Managing Director of Anand Rathi Share and Stockbrokers, who will be talking about their 750 crore rupee IPO. You don't want to miss this.
Welcome back. Anand Rathi's 745 crore IPO opens for subscription today. Pradeep Gupta, Chairman, Managing Director, and Anand Rathi is now here with us in the studio. And today's conversation, we will focus on one, how is Anand Rathi's share navigating all the regulatory risks? 2, what are the growth and expansion plans ahead? And 3, will FY26 be better than FY25? And if yes, by how much? Thank you very much for joining in. Now, over FY23 to FY25, you've clocked in a revenue growth of about 34%. But we've seen SEBI clamping down on F&O. There is a possible discontinuation or weekly expiry, which can hurt volume. So in that context, can you do better than your historical growth rates of 34% on the top line?
First of all, good morning, Rima, and to all the viewers of CNBC. Yes, I think so far...
Please.
Okay.
Yeah, go ahead.
So far, business is concerned. I think you have to literally look at it, how the business model is being created. And we are very confident that this kind of a growth is going to be persistent and stay with the company. And that's the reason, we are trying to see a different way or innovative way how it is to be done. Typically, what we are trying to see, as we all know, pure broking is something which is directly correlated, and there are lots of, involvement of market volatility. And the moment market volatile, your broking revenues also start getting volatile. So to aloof yourself from that, you have to create a business model where probably how you can, create a model which can give you a sustainable long-term growth and a predictable growth. And that's where, if you really look at Anand Rathi share in stockbroking, which is coming for public, largely having a two kind of a revenue stream, broking and non-broking. And within non-broking, if you really look at it, distribution is one part and margin trading facility is another part. And these two businesses, which is in non-broking side, is largely annuity-driven businesses. So the moment you start looking at AUM, you start getting certain amount of annuity revenue.
So could you, Mr. Gupta, break that down? How much is broking? How much is...
So in Anand Rathi share and stockbroking, if you really look at it, right now, broking 60%, non-broking 40%. And that's the whole endeavor is how we can constantly...
And what have been growth rates in both these, broking and non-broking?
So if you really see in broking about 20 to 25% and non-broking about 35 to 40% kind of a growth is there. And the whole endeavor of this company and the people, management, everything is working towards it, that how we bring this ratio to 50-50. The moment we reach 50% kind of a revenue ratio, I think you are going to be less susceptible to the market volatility on this company, and that's what we are trying to
How
achieve.
soon do you think it will take you all?
My own perception and guess is, I think in next 2 to 3 years, we'll be able to achieve
You said 60-40.
It's 60-40. 2 years back, if you really say it was 65-35, and we are trying to achieve and gradually working towards
On the broking side, will revenues, the growth decelerate? Let me put it another way.
No, not really. It is going to be constantly grow at the same pace, point number one. And point number two, if you really again look at our broking model vis-a-vis any other companies, and as you rightly pointed out, the way regulator is looking at derivative businesses, there is another component in broking. Broking, cash market and derivative market. Cash market, pure cash plus cash trading. Derivative market is, commodity, currency, and future and option. Now, over there also, if you really look at Anand Rathi share and stockbroking, it's 50-50. Okay. If you compare with any other broking houses or most of these broking houses, their probably this ratio might be tilted towards...
Cash and derivative is 50-50 within broking.
Cash and derivative is 50-50, and within derivative, commodity, currency, and F&O, all three put together. So our dependency on those future market businesses are very, very less. And this whole structure is being not came by default, it's being by design, by strategy which we have set, because we are always advocating customers who are looking from a long-term investments, who are looking from a staying and creating over a period of time, certain amount of investable surplus and constantly generating certain amount of return. And that's the reason, if you really see this 50-50 is maintained, our focus is to our cash market delivery. And if you really look at our yields, are constant from last almost 4 to 5 years, which is 0.09 paisa, which is 0.009%. I think that's the yield, kind of yield is being static in broking businesses. And as I said, broking is about 60% in overall total revenue business.
All right. Hi, Mr. Gupta, and good to have you on the show. In the last issue that the Anand Rathi came out with, it generated a lot of wealth. So some of your investors will be hoping that you replicate that performance. That said, there are some challenges, right, in the near term at least. So the non-broking component would be the interest on the MTF book as well, which has grown. It was 50 crores a few years ago. Now it is at more than 100 crores or thereabouts. But the regulator is also looking at this part of the business. They want to, make it, more friendlier for users. Do you see that as a bit of a headwind? Because that clearly has been the outperforming part of your business if I look at your revenue construct.
See, fortunately, Nigel, it's a very good question. I think one has to look at it, how you are playing your cards in terms of providing funding side. And if you really look at it, margin trading funding is well regulated. Every day, all the positions are being controlled and are available at stock collection level also. So if you really look at our margin trading funding, this is largely given to those customers who are looking to increase their ROI.
Okay.
right? So that means, what that means is our internal controls and systems are that we are not allowing over-leveraging any kind of a customer. So there are checks and balances being created. If you really glance through our book, almost 75% book is below 1 crore customers, right? And there are hardly or very few customers who are getting above 1 crore kind of a funding.
Yeah.
And what we are trying to see, whosoever wants to leverage their position in a systematic manner, trying to generate and increase their ROI, are being given this category group. The second instance, I think if from a regulator perspective, about 1,900 stocks are available for our margin trading funding book. Out of that, what we have done, internal systems, internal control says not 1,900, but only 900 scripts are going to be available with a different kind of a margining system. Right. And if you really glance through our book, about 75% book stays in Nifty 500 stock. So it's well spread, well controlled, and we see that there is no...
So short point, you believe the MTF book, will continue, the interest on that will continue to generate a good amount of revenue for you, given the checks, the balances, everything that you have done. Got it. All right. Now, what about, I've looked at the NSE data in terms of market share. You're still relatively small, if you compare it with the bigger names. Do you have a target out here, that you want to go up? Because obviously you're growing the business, a lot of focus out there. And now you'll have shareholders that will keep asking you this question. So is there a target out there?
I mean, it's again good question. I think we as a strategy have not taken that route that we have to constantly look at market share and constantly look at the turnovers. Yeah. There are two kind of different businesses. Companies who are literally looking at turnover side and constantly trying to expand their market share in turnover. We are not going towards that. What we are trying to focus is on an individual investor whose investable surplus can be addressed through us, and we constantly trying to increase with that same investors how the AUM of that particular investor can grow along with us, so that investor can be beneficial, and as well as we also can start getting our revenue stream over a period of time. As a result, if you really see, our 30-year plus kind of investors are almost 85%. Okay. If you really look at stickiness of our customers, 5-year plus is 50% and 3-year plus is about 60%. And similarly, to service these people, our RM fraternity, managerial plus kind of a people with us, again, fortunately, it's the same ratio, but 5-year plus is about 50%, 3-year plus about 60%. So that's how the whole component is being created, whole service standard is being created to service those customers.
Mr. Gupta, just one last point on MTF. What is the available amount that you can fund?
So from a regulator side, you can fund, 50% of your net worth and 5% of total overall net worth, you can go and probably provide it. Right. But for that, you need liquidity.
Right. No, but from an individual perspective, if I want to take a position worth 100 rupees, how much will...
Based on the margin. Typically, 30% to 35% kind of a margining is there. So if you are providing security or a margin of about 30-35%, you can go to any extent. So it all depends on what kind of a ratio you are following, what kind of a rules and regulations.
For every stock, it is different as well. I think for NBFCs, there is a limit prescribed by the RBI, right? That's 50%.
So NBFC is completely different. They are not on MTF side. Correct. They are on a LS side.
Correct.
So they are providing LS, and over there, they have a 50% kind of a margin.
Mr. Gupta, we wish you all the best of luck. Thank you very much for joining us.
Thank you.
Really appreciate it, and good luck. So there is Anand Rathi with the IPO on the broking side. But it's not just broking, as Mr. Gupta told us. It's broking, non-broking, which is, of course, distribution, and the MTF book as well. More annuity, more stable, and it's about 40%, and in the next couple of years perhaps goes up to about 50% each. Well, I think, well, that's goodbye, Mr. Gupta. No problem. All right, Vinay Rajani is with us, Senior Technical and Derivative Analyst at HDFC Securities. Vinay, good to have you with us here. Good morning. How would you look at things? Markets kind of come off a little bit, down 60-odd points. Your trades, Nifty and stocks?
Yeah, sure. So good morning. So from the level of 25,448, we have seen a healthy correction. It can be said running correction in the overall bullish trend. So the 1,000 point rally which we saw from the level of 24,400 to 25,400. So it is retracing that, and right now the 38.2% retracement of this entire 1,000 point rally is placed around 25,050. So this is the immediate support we see in the Nifty that should act as a strong support. So primary trend is bullish. 20 days EMA is also placed around 25,040 odd level. So there are two important supports which are coinciding around the same level. So we can say that there is a strong support between 25,000 to 25,050, which should act as a strong support. So it is a running correction in overall bullish trend. Still Nifty is holding above the key moving averages. So we have a hope that it will resume the uptrend. And some sectors are still performing well, like auto and metal. So overall broader markets are not that much weak. Some sectors are still participating. That's why it seems like a more of a profit booking and not a reversal. So dip should be bought into. That's what we are advising to our clients. And 25,000 to 25,050 should be the strong support. As far as support, the stocks are concerned, yes, there are both way opportunity, like pharma sector has been underperforming for last two trading sessions. So Cipla can be shorted because the technical setup is looking weak. So Cipla September future, I would suggest to go short around 1533. I would suggest a stop loss at 1555, and on the downside we can expect a target at 1495. The second pick I would choose on the long side from the auto sector only, that is Samvardhana Motherson. So Samvardhana Motherson is placed around 1111. So one can go along around this level. I would recommend a trading stop loss at 108. On the upside, I'm expecting a target of 116. 116.
Thank you for joining in. The mid-cap index is down close to about 0.5%. The Nifty hovering around yesterday's low. But Vinay's view is accumulate at the corrections and support seen at 25,000, 25,050. But let's talk about autos. That's the only leg in the market that's holding up in the green. Sudarshan joins in with the latest numbers on Maruti, Hyundai and Tata Motors.
So in a day where most of the stocks are under pressure, one sector that is holding the ground is the auto sector, and it's on the back of the commentary that companies have been giving on the first day response that these companies have received on the first day of Navratri. So first, starting with Maruti, it's saying that inquiries that company has received, it has not seen in the last 35 years, and also that there is a possibility that it might run out of inventory for some of the variants. On the first day of Navratri, it has received inquiries for almost 80,000, and it has delivered more than 25,000 cars, and it expects that very soon it's going to deliver almost 30,000 cars. Since 18th of September, the day company had announced GST pass on and also additional discounts, from that day it has been receiving inquiries of almost 75,000 and has been making bookings of almost 15,000. That's 50% higher than that company has been seeing on a regular basis. The biggest positive is the response that company has got for the entry-level segment, where it's saying that response has been 50% higher than the normal days. Second is Hyundai. It's saying that it has delivered more than 11,000 cars, and now it's saying that there is an expectation that this kind of momentum might sustain. And just a few minutes ago, we have received the update from Tata Motors, where it's saying that on the first day of Navratri, it has delivered more than 10,000. So, but do factor in that August, for better part of the month of September, it was a Shraddh period. So there was not much sales that we had seen. So it can be taken positively as well.
Indeed, there were no sales up until now, and people were also waiting for the price cuts to come into effect apart from Shraddh. Thank you very much, Sudarshan, for putting it into context. Get into a break. On the other side, we'll talk commodities. Manisha Gupta will join in. Stay tuned. Welcome back. As promised, let's turn our attention to the commodity markets. Manisha's at the big wall. Manisha, what are you looking at today?
Well, gold and silver, I'm not taking my eyes off that because it's another all-time high in the Indian markets when you look at gold and silver. It has been one long string and unbeatable, unstoppable. I can look at a lot of those synonyms there for the month of September, but that's exactly how gold and silver really seem to be behaving. So you have gold prices trading at $37.50 an ounce, which is an all-time high, and we did see prices move ahead of that as well. For the silver prices also, it has been one-way rally for the last 3 months or so. It has outperformed gold also. Silver is trading at a fresh 14-year highs in the international markets. We've seen $44 an ounce onto that one, while the Indian markets have crossed about 1,32,000 rupees per kg there. Well, it has to do with the rate cuts from the US Fed and Bank of Canada that we saw in the previous week. And of course, an anticipation that you're looking at more rate cuts for the month of October and then December, and then one more rate cut in the first quarter of 2026. That's exactly what the markets seem to be factoring in at this point in time. And then you have geopolitical tensions which continue to brew in. There are headlines coming in from that. The ETF buying has been stronger in the global markets and the Indian space as well. The central bank buying for a fourth straight year in 2025 also promises to be around that 800 to 1,000 tons of net inflows. And all of those factors clearly have been very, very supportive there. If you look at the gold now, it also is taken over euro and is the second largest component when it comes to various forex reserves that we've seen in 2025 till time there. I also want to take you through on what we've seen in sense of gold trajectory for 2025. So that is what Jan looked like at $26.50 an ounce. And then look at the month of March, $3,050. So we saw that $400 of a jump up come in 4 months there. $3,500 an ounce was an all-time high that we saw in the month of April. It held on to that range between 33 to 35 until the month of August, and then September has seen an all-time high of $37.50. Look at silver. Even as gold saw some consolidation there, silver did not see that. We started the year with $29.50 and then $33, $39, and we're standing at $44 an ounce at this point in time. So it has been a 50% of a jump up that we have seen in case of silver prices in this year until now. What is the scenario going forward? And that's exactly what we're looking at right now. Citi talks about 3,800. We're trading at 3,750 right now. Commerce Bank has talked about 3,600 of an average. So we still have higher sides to go there. $4,000 an ounce is what Bank of America and Deutsche Bank are talking about. And this could be this year or the next as well. So the timelines really seem to be fading here. And Goldman Sachs has talked about 5,000, but that comes in with ifs and buts. And if this happens, is the best case scenario that they see in case of gold going higher. This is what we're looking at silver then, and we're trading at 44 right now. 43 of an average is what Citi has talked about, and 45 is what Saxo Bank, Metal Focus has talked about. It also has been higher levels that we've seen come in for the market, and then there is a big divergence as well, because when you look at HSBC, they've talked about 34. We're trading at 44 right now, and then you also have First Majestic. Well, the timeline from First Majestic hasn't come, but $100 an ounce again is a level that First Majestic has been talking about since 2016, and then Deutsche Bank is talking about 45. So, well, yes, when it comes to silver, 44, 45 seems to be an understanding there. And then, of course, you have a large divergence coming in from some of those brokerages too.
Wow, on fire. You know, prices are already ripping, and we've not seen this kind of a gain in a long time. Thank you, Manisha, for that. Get into a break. On the other side is a special segment. It's The Economy. Lata speaks to economists Jahangir Aziz and Luis Organis of JPMorgan on the global Asian economies, currencies, commodities on the sidelines of the 10th JPMorgan Annual India Conference.
Welcome back to our coverage of the JPMorgan 10th Investor Conference happening here in Mumbai. And now I have with me what I would consider two of the most important guests to parse for us the global economy, the commodities and the currency markets. I have with me Luis Oganis, who is the head of global macro research, including currencies and commodities, and Jahangir Aziz, a familiar face, who is the head of EM economy research for JPMorgan. Gentlemen, thank you very much for pulling yourselves out of this busy conference and giving me time. Luis, the Indian audience has a lot of questions for you on gold. I mean, it's just like a one-way rally. We've 45, 50% rise in a year. Where does this go from here over the, say, next 1 year or two?
It's interesting, Lata, that gold, it took 12 years for gold to go from $1,000 to $2,000 for troy ounce, 4 years only for 2 to 3, and it's going to take, looks like, less than 1 year to go to 4,000. So we do think that 4,000 is within the horizon. In the forecast formally happens in the first half of next year. It could certainly happen before then. And from then, we think that the gold continues to go up. I mean, we have discussed in some reports that in a couple of years we could see 6,000 mark, right? So a lot of things behind that, certainly geopolitical risks, concern about, U.S. Fiscal dynamics, and, the weaponization of the dollar has forced many central banks to start to diversify away from the dollar, the de-dollarization dynamics, and of course, the most recently, the attacks on Fed independence seems to be also fueling the demand for gold. So a lot of reasons why gold seems to be a quote-unquote good refuge.
Okay, so 4,000 looks very much round the corner, and you would not even dismiss 6,000.
Absolutely.
Okay. Would silver be as good?
Well, the difference between gold, silver, or gold in any other metal is that gold, the supply is extremely inelastic. So the possibility to basically produce more because prices are higher is very limited. The mining takes forever, the exploration takes forever, and which is probably not quite the case for silver. So I would say probably the precious metal complex, there's going to be some correlation. But if you want to focus yourself on one bet, I think gold is the one.
Okay. Well, I want to ask about dollar to actually both of you. Let me start with you. Do you expect, Jahangir, that the dollar index will head even lower, considering that the Fed is expected to cut? So two questions, actually. What are you expecting from the Fed, and what are you expecting from the dollar index over, say, a year horizon?
So we started off the year, let's go back to December, when we had the tariff threat. And on that basis, the answer was that the dollar was headed up, appreciating, right? So it turned out that after April 2nd, when we did get the tariff increases, in the first leg was a dollar depreciation. And over the last, I would say, 1.5, 2 months, Luis, dollar has been moving essentially sideways. Now, so while rates have gone up in the U.S., not in the last 2 weeks, but yields have gone up compared to other countries, we have seen the dollar depreciate. Now, both Luis and we made our careers working on emerging markets.
Yes.
So if you ask any emerging market country, why is it that yields are going up and the FX is going down, the answer is, well, that's because the yields are going up because there's an increase in country risk. Okay. If you look at it that way, then it sounds plausible that you will see yields going up and the currency depreciating. It is when we go back to the old 80-year framework of looking at interest rate differential and growth differential, then we start scratching our head. That why is it that the dollar, after the initial step down, actually has remained range bound? We still think that the dollar is headed softer. We'll have I think dollar euro at about 117, is at 113 now. All of that heads towards that, but I think we will have to go through the volatility of the dollar remaining and surprising us. But the way we are looking at it is that I'm from emerging market, he's from emerging market. This is what happens when this premium on a country goes up.
Okay, for us it's more important because the rupee is at an all-time low as we speak, 88 and 88.55 or thereabouts. It's really fell a lot today. What's your sense? Does dollar weaken, but rupee weaken faster? It's an outlier.
It's an outlier, and maybe for good reasons, right? There's been several headlines that have generated uncertainty here. We can discuss further tariffs, etc. The rupee is screening cheap, quote unquote, in our models. That doesn't mean that the mean reversion is going to happen very soon, because we need some of these sources of uncertainty to clarify. But I think that, as Jahangir was saying, we are cautious on the dollar. We think that there's probably more dollar weakness in store. That, in principle, helps. The dollar is going to be depreciating not only against reserve currencies, but also against emerging market currencies, the rupee included, right? So if you look at the forecast that we have 1 year out, which, of course, is an educated guess, it is marginally stronger than what it is right now. So this is a bit of a signal that, yes, in the near term, probably there's going to be volatility for the rupee. But to the extent that some of these sources of uncertainty clear up and the dollar continues to weaken, that should prove eventually supportive for the rupee.
So the rupee is cheapened enough.
Yes.
All the bad news is in the price.
Yes.
Okay, Jahangir, let me come to the India growth story. Let's not get into the GDP numbers. We don't have it. We have a deflator issue, etc. But on a more qualitative basis, we have adverse impact of the tariffs. Now, almost a tariff on services. But on the other hand, the government has gone all out to encourage consumption. And the first numbers we are getting from auto sales and all is very good, obviously because August was also zero. So do you think that the domestic growth stimuli are more or less neutralizing and the country is on a reasonable growth path?
So let's look at it. Let's pass the tariff impact first, and then let's look at the GST impact. If you look at the tariff impact, if you look at the exemptions that exist on energy, on pharmaceuticals, and on electronics, then the impact is only about 1.1% of GDP of total exports is exposed to the US. And you do any kind of calculation over there, you're not going to get very much of a quote-unquote growth impact. However, that 1.1% of GDP includes textiles, leather, shrimps, gems and jewelry, which are extremely labor intensive. So I think you're going to get an impact where the growth impact is modest at best. But the employment impact is where I think the concern is. And that is where I think one needs to look at. There is going to be a very large employment impact, but it's not going to be that bad of a growth impact. Now, if you look at the GST, which is being seen as a counter-cyclical measure to the tariffs.
What consumption cannot go out, let it be domestic.
So let's look at the arithmetic. The arithmetic is that the total amount of decline in GST revenue, as stated by the government, not by me, is 0.15% of GDP. So the increase in household income is just 1.15% of GDP.
1 minute. The numbers were clarified by the CEA yesterday. It is, the compensation cess also has to be included. That's 1.2 trillion rupees, plus GST of 48,000 crore rupees, plus an income tax cut of 1 trillion. So we are looking at a 2.5 trillion.
No, but that's all that you're going to get in terms of household income increase. And then you take 70% of that as consumption and 30% that of this thing. You are going to get a step up in consumption. As long as the step up takes, say, 1 quarter, 2 quarters, it is going to show up as higher growth. But that's it. It stops exactly there. Unless you're telling me that every year GST is going to get cut. It is not going to get cut.
We are hoping that the way in which, for instance, there was a cement producer who says that he sees a clear 1%. If he was bargaining for 5 to 6%, he's now looking at 6 to 7%.
But the other problem is that if you look at, let's say, textiles, India exports textiles which is sold in Bloomingdale's and sold in Bergdorf and Goodman. Gems and jewelry of Sabyasachi is sold in Bergdorf and Goodman. I don't think there are very many people in India who can substitute those things by shifting to domestic consumption. I think we have a problem there. Look, again, I'm not saying that you are not going to get a push on a consumption growth. You have to. You're getting a tax cut. But it's limited only to a level shift.
Well, we are hoping it'll churn the capex cycle, but that question for another day. I want to get two big macro questions out of the way. One is the Chinese disinflation. Okay, let me start with you on that. Do you think that continues? Because now it looks like China is trying to correct some overcapacity, stimulate domestic consumption. Have we seen the worst of Chinese disinflation, or is there more?
Not really. I mean, if you look at what they call the anti-involution strategy, right, which is essentially saying that I'm going to strongly encourage you not to cut prices, it means that the inventory still remains. You cannot get rid of the inventory. If you're not going to get rid of the inventory, you're going to cut production. And if you're going to cut production, growth is going to fall. So in third quarter, we have already downgraded Chinese growth. We have downgraded, so Chinese growth on a year-on-year basis is going to be about 4.5% of GDP. Next quarter is also going to be about around this thing. But I think that once these numbers come out, I think the anti-involution policy is going to be stepped back because it is actually having an impact on production because you're not allowing inventories to clear. And we have seen demonstrated impact of that in the housing market. In the housing market, they have not allowed the secondary prices to adjust. And consequently, for 4 straight years, you are seeing the real estate market in quantitative terms still adjusting. Real estate investment turned negative about 3 years back. It is still negative. So
short point for an Indian investor who's looking at the WPI numbers getting impacted by Chinese dumping, that continues.
It continues to this thing, and therefore, we won't get into the math of GDP. GDP can get boosted simply because of that.
The disinflation is an important input
Yes.
for people making decisions, as is the dollar.
Yeah.
The other big macro issue is over-leverage. The US fisc has gone overboard, so are the European fiscal balances. How will all this impact emerging markets? Are we going to see some kind of a blowout? For the next 2 years, how would this problem impact us?
So there's a couple of things. Certainly the problem of fiscal largesse and high debt that is so prevalent in emerging markets. Now it's also quite prevalent in the developed markets, right? You have seen it, I'm based in London, we see it in the UK, right? The recent problems in France are related to also debt to GDP that they don't know how to contain, right? There's no easy solutions that are politically acceptable. In the US, clearly that is an issue, right? That's why the long end of the yield curve in the US has this term premium, right? And this big, beautiful bill is not going to help matters, right? It runs the risk of increasing the deficit unless growth comes back to the rescue somehow. So what that's going to mean, Lata, is that I think that for the foreseeable future, long-end interest rates are going to remain high, right? So we need to get adjusted to the notion that, hey, looking back the last 10, 15 years, we thought that inflation problems were over and that low interest rates were here to stay. Well, that's not the case anymore, right? So interest rates are going to remain higher. Now, for emerging markets, that the high interest rate in the developed world is never a good thing, right? Because it means that the cost of borrowing goes higher. That said, what we're seeing right now is that capital is looking for places to feel quote unquote safer, right? And there are some emerging markets where the fiscal dynamics are not that bad, are more sustainable, and that they at least have the promise to attract some of this recycling or reallocation of flows.
Do you think FPIs come back to Indian bonds? Will they find Indian bonds attractive?
I think that eventually will, because right now what is happening is that the RBI pretty much is done. The market is pricing some potential for additional cuts. Certainly, there's some risks of growth on the downside, as Jahangir has mentioned, and maybe the RBI seems it in a world in which the inflation is actually quite low in India, right? That maybe they cut further, and that could entice some more capital inflows into India. The issue is that India is facing a lot of competition from high yielders around other countries. I mean, in EM, right? So
and whose currencies are not depreciating.
Yeah, no, we're talking about 5.5% policy rate here in India. In Brazil, it is 15%, right? And they're going to be cutting. So everyone is salivating at that process, right? So again, competition is hard.
Okay, unfortunately, out of time. Other shows are competing, but I would want to detain both of you on another day for a longer chat on global macros. Thank you very much, Jahangir and Louis.
Thanks very much, Lata.
Thanks for having us.
Well, that's it on this edition of It's the Economy. Back to you in the studios, Chartbusters, after a break.